The Great Investment Divide, Dividends versus Index Funds. The journey to financial independence is often paved with good intentions and a variety of strategies. Two of the most common paths involve a choice between high-yield dividend stocks and broad market index funds. To the casual observer, both seem like solid ways to build wealth over several decades. However, when we peel back the layers of psychology, taxation, and mathematical compounding, a startling gap emerges. Let's follow the parallel lives of two investors, Jake and Marcus, to see how these choices play out over a 30-year career. Two investors, one goal. Jake and Marcus are both 30 years old, earning $75,000 a year and living in the same city. They both commit to investing $1,000 every single month into a standard taxable brokerage account with the goal of retiring at age 60. Jake's strategy: the income seeker. Jake is drawn to the tangible nature of dividend investing. He spends his weekends researching dividend aristocrats, companies like Coca-Cola and Johnson & Johnson that have a long history of increasing payouts. He also adds high-yield ETFs and real estate investment trusts, REITs, to boost his average yield to 4%. For Jake, every quarterly dividend check feels like a win. It feels active, strategic, and productive. Marcus's strategy: the simple optimizer. Marcus chooses a path that is almost embarrassingly boring. He sets up an automatic purchase of a single Vanguard S&P 500 index fund, VOO. He doesn't track yields, he doesn't read annual reports, and he doesn't care about individual companies. He simply buys the entire U.S. stock market and goes about his life. The illusion of winning. In the first 5 years, Jake appears to be the smarter investor. His portfolio is generating roughly $2,800 a year in passive income. He sees cash landing in his account that he didn't have to work for. Meanwhile, Marcus sees nothing but a fluctuating number on a screen. He has no checks to show off at a barbecue. However, Jake is falling victim to a psychological smokescreen. While he celebrates his cash flow, he is missing the invisible costs that are quietly eroding his future wealth. The mathematics of dividend irrelevance. One of the most misunderstood concepts in retail investing is the nature of a dividend payment. Many investors view dividends as free money or a bonus added to their account. In reality, finance theory, specifically the Miller-Modigliani theorem, dictates that a dividend is simply a forced partial sale of your position. When a company trading at $100 pays a $2 dividend, its share price drops to $98 on the ex-dividend date. You haven't gained $2 in value. You have simply moved $2 from the company's ledger to your brokerage account. The critical difference is that the moment that $2 hits your account, it becomes a taxable event. The 3 leaks in Jake's bucket. Jake's portfolio suffers from 3 specific leaks that don't exist, or are much smaller, in Marcus's index strategy. The tax drag. Every dividend Jake receives is taxed in the year it is paid, even if he reinvests it. Qualified dividends are taxed at lower rates, 0%, 15%, or 20%. But many of Jake's high-yield assets, like REITs, are taxed as ordinary income, potentially up to 37%. Over 30 years, This tax leakage can cost an investor hundreds of thousands of dollars in lost compounding power. Sector concentration. Dividend-focused portfolios naturally lean toward old economy sectors, like utilities and consumer staples. By focusing only on companies that pay high dividends, Jake systematically underweights the technology sector, the very sector that has driven the majority of market growth over the last 2 decades. Expense ratios. While Marcus pays a tiny 0.03% fee for his index fund, Jake's specialized dividend ETFs often charge between 0.06% and 0.35%. This small decimal difference, when compounded over 360 months, turns into a significant sum. The 30-year reveal. As the decades pass, the gap between feeling like you're winning and actually winning becomes a chasm. Metric after 30 years, Jake, dividend strategy. Marcus, index strategy. Final portfolio balance, approximately $1,410,000, approximately $1,780,000. Total taxes paid, approximately $48,000, approximately $3,000. Annual return drag, 1% due to taxes/fees, 0% baseline. By age 60, Marcus has outperformed Jake by roughly $370,000. Jake never noticed the loss because his account balance was always going up. He didn't realize he was winning less than he should have been.
Money.
The retirement tax trap. The disparity doesn't end at retirement. When they both need $50,000 a year to live on, their tax situations look entirely different. Jake's situation. His portfolio generates $56,000 in dividends. He is forced to take this income and pay taxes on it, regardless of whether he needs the full amount that year. After federal taxes, his take-home pay is roughly $48,000. Marcus's situation. Marcus sells $50,000 worth of shares. Because much of that sale is a return of basis, his original investment, and he can manage his long-term capital gains to stay within the 0% tax bracket, his tax bill is nearly zero. He keeps almost the entire $50,000. Furthermore, if Marcus passes away and leaves his portfolio to his heirs, they receive a step up in basis. This means all those decades of capital gains are wiped clean for tax purposes. Jake, however, already paid taxes on his dividends every single year. That money is gone forever. When do dividends make sense? It would be unfair to say dividend stocks are bad. They are simply often used in the wrong context. There are 3 scenarios where Jake's strategy would actually hold water. Tax-advantaged accounts. Inside a Roth IRA or 401k, the tax drag disappears. If you enjoy the psychology of dividends, these accounts are the only place they truly belong. The behavioral edge. If the quarterly dividend checks are the only thing that keeps an investor from panic selling during a market crash, then the mathematical loss is worth the behavioral gain. The best strategy is always the one you can stick with. Retirement complement. In the final years before retirement, shifting a small portion of a portfolio toward dividend growth stocks can provide income stability. The key is to treat them as a supplement, not a replacement for a core index position. Final thoughts. Total return versus passive income. The marketing of passive income is powerful because it appeals to our desire for immediate rewards. However, for a long-term investor in a taxable account, total return, capital appreciation plus dividends, is the only metric that truly matters. Building wealth is not about how much cash hits your account today. It's about how much wealth you retain after taxes and fees 30 years from now. For most people, the boring index fund isn't just the easier path, it's the one that leaves you with a significantly larger fortune.